All right. So we're going to go over investor loan examples. Let's go over the very first example. So right now, if we have, for example, an investor that comes to you and they want to purchase a single family residence or a house, and they want to finance 50% of the purchase price, which is 500,000 for a purchase price of 500,000. And they want to know what their payments are going to be if they have an 8.5% interest only rate. What their prepayment penalty is going to be. So more or less on almost all investor loans, the investors are going to all have interest only loans. And how do you calculate interest only loans? It's actually very easy. You're going to take the loan amount and multiply it by the interest rate, and then that's going to be their annual interest, and you're going to divide that by 12. So over here on the example, on the solution, we see that it says 500,000 as the purchase price. We multiply that by 50%, and that gives us $250,000, which is actually the loan amount, because it says they're financing 50%. So their down payment is going to also be $250,000. So they're probably going to have to provide bank statements showing those $250,000. And normally they also have to include their closing costs in addition to those $250,000. And they also, not always, but most of the time, they have to have at least like 6 months reserves of payments that will include the interest only payment, their taxes, and their insurance. Okay. So now let's go ahead and finish this calculation. So we're going to take the loan amount of $250,000 and we're going to multiply it times 8.5%, which is the interest rate. And then we're going to divide that by 12 because there's 12 months in a year, so that we can calculate their monthly payment. So by doing that, we get 21,250 divided by 12. Their interest only monthly payment is going to be $1,770.83. So if they ask you, what's my interest only payment going to be based off that interest rate? It's very easy on any calculator. You don't even need to have a mortgage calculator. You just take the loan amount times the interest rate and divide that by 12. And then to calculate the prepayment penalty. So a prepayment penalty on investor loans. Normally when somebody goes and buys a home to purchase and live, they normally won't have a prepayment penalty. But most investors are going to have a prepayment penalty because they're usually going to resell the property after a year or 2 years or 3 years. But a lot of investors now have been asking for 30-year mortgages, which we do provide, which is very, very important. Why would this be important? Because we actually want investors that are going to rent the property right now, because those are our target investors that are going to purchase a property and not necessarily fix and flip. They're going to actually simply rent it. And when the economy slows down and things get really bad, which eventually things will slow down, interest rates will go higher, property values will go down, and then people will need to sell their properties. And that's when investors are going to come in, and that's where we're going to be very busy, because all these investors need financing. So instead of buying one property with their $500,000, like in this case, in this example, they could purchase 2 properties by putting $250,000 on each property. So that saves them money and allows them to increase their investment on 2 properties, which will also increase in value at twice the rate instead of having it with just 1 property. So let's go back to prepayment penalty. So normally most lenders that do investor loans have either a 5-year, 4-year, 3-year, 2-year, or 1-year prepayment penalty. Borrowers can choose not to have prepayment penalties. What happens when they don't have a prepayment penalty? The only difference is when the least amount of years that they have, or the lower amount of years that they have in terms of prepayment penalty, will usually mean they're going to have a higher interest rate as well. So if somebody just wants to have the lowest interest rate possible, then you would ask them if it's fine to have a 5-year prepayment penalty, because that's the interest rate that's going to be the lowest. And if they don't care what the interest rate is going to be, they just want to have the flexibility of not having a prepayment penalty. So in that case, they could choose not to have a prepayment penalty and have a higher interest rate. So if they had 8% interest rate, they might have a 9% interest rate. So that's very important. So in this case, let's assume they have, just like we have here on the example, if they have a 3% prepayment penalty, if they sell before the first year. So within those first 12 months, they have to rent out the property, but they can't sell it or refinance. So prepayment penalty will kick in if they refinance or if they sell, in both situations. So how would we calculate the prepayment penalty? Very easy. We would take the loan amount of $250,000 times 3%, which would be $7,500, and that would be their prepayment penalty. Now, investors, when they're making a profit of $50,000, they usually won't care that they're having to pay $7,500 as a prepayment penalty. So you shouldn't stress over that or worry about that. You give the borrower the option, higher interest rate, no prepayment penalty, or maybe they just want to have a 2-year prepayment penalty and the interest rate is slightly higher, or they accept to have the 5-year prepayment penalty and have the lowest interest rate. So that depends on what their plan is, to either hold the property for 30 years and they don't care about the prepayment penalty because they're going to hold it anyway for past 5 years, so it doesn't matter. So this is example number 1. Does anybody have any questions? How does everybody, did everybody more or less get the idea? I'm going to give everybody just a few seconds, just in case anybody wasn't sure about the example I gave right now. You can send it through a chat, or you can go ahead and just ask me right now over the Zoom call. No? Okay, so let's continue. Let's move on to example number 2. So I'm going to give you different examples, not just with investors, but also in terms of your compensation, how you're going to get paid, your commission. So these are important examples that you're going to really benefit from. Let's go ahead and move on to example number 2 now. So in this problem, for example, number 2, we have a real estate investor that needs to refinance their mortgage, and they have a condo that they'll actually be refinancing 40% of the appraised value. So what does this mean? Including the closing costs, obviously. So what does this mean? So let's say they have a condo that's worth $400,000. They're going to be refinancing 40% of that. So if we go ahead and we take, like in this example, $400,000 times 40%, we get $160,000. So that's how much they're going to be financing. And their closing costs are going to be included into those $160,000. If they wanted to have exactly $160,000, we would have to increase the loan amount to cover the closing costs as well. So their actual loan amount might be $170,000 or $175,000 if they wanted to have the exact $160,000 and then cover the excess of the closing costs by increasing the loan amount. But in this case, we're just assuming it's $160,000 and it includes the closing costs. Now, in this case, the borrower is going to have a 7.99% interest rate. So how do we calculate the interest-only payment? So very easy. All we're going to do is we're going to take these $400,000. We're going to multiply it times 40%. Remember, $400,000 is the estimated appraised value. And we get $160,000 as the loan amount. So we're going to take that amount, just like we did in the last example. We're going to multiply it times 7.99%. Or you could also enter 0.0799, which is the same thing as 7.99%. And then we're going to divide that by 12, or we're going to find that the interest-only monthly payment for this borrower is $1,065.33. And that's how we would calculate the interest-only payment for this investor problem. So this was a pretty easy example. We had a similar problem just a minute ago, so you guys saw what it was all about. Let's move on to example number 3, so we get into different situations. So in this case, we have a more experienced investor. And this investor wants to purchase a single-family residence, and they want to know what their prepayment penalty is going to be on a loan amount of $1.1 million or $1,100,000. And we're going to assume that the prepayment penalty is 2%. So very easy. We're going to take the $1,100,000. We're going to multiply it by 2%, and we get $22,000. So if they sell the property before the 2 years of their prepayment penalty, their penalty is going to be $22,000. Possibly on that $1,100,000 property, they're making a profit. If they're reselling it at $1,500,000, they're making $400,000. They don't care about $22,000. So again, we don't worry about it. That's their, if they decide to do that, that's perfectly fine. It's up to them. If for any reason the investor tells you that they're going to resell it before the prepayment penalty, that's very important. And we're going to talk about that in a minute when it comes to your compensation, because many times the borrower can have a higher interest rate and the lender will pay you part of your compensation or pay us part of the compensation. Other times, the lender doesn't pay us anything. We charge the borrower all our fees up front. And that should be the case whenever you have these types of loans, because if the lender pays you and the borrower has a prepayment penalty, if for any reason the borrower refinances or sells that property beforehand, before those 2 years, then you have to return that portion of what they paid you, because that was part of their profit that they paid you on. So in that case, if you know the borrower is going to do that, it's a much better idea to just simply go ahead and charge the borrower all the fees up front, so the borrower pays you the compensation. Other times in these types of investor loans, it's very nice because you can actually have both pay you, the lender and the investor, and then you kind of increase your profit. But we're going to go over that in just a minute.
At most time.
Hey, Debbie, how are you doing?
Oh, good. How you doing? Sorry about that. I was talking to my daughter just then.
No problem.
Yeah, no, I'm just sorry I'm a little late for your session here. Am I the only one here? No, I see seven others. Okay.
There's more people. We're
Okay.
going to go ahead and move on to example number 4 right now. We went through calculating interest only payments right now, Debbie, and prepayment penalties. Let's see. So let's go over the next example. We're going to go over your compensation, how much you're going to make, how much you're going to profit on these loans. So in this example number 4, we have an investor that's purchasing a $900,000 multifamily home. Now, when it comes to an investor could purchase a house, a condo, a townhouse, a multifamily home. When they purchase a home that's more than 4 units, or it becomes 5 units, then it becomes a commercial property. And we can also do commercial properties. There's just different lenders that we work with. Normally, you'll make more profit or compensation as a loan officer when you stick to the properties that aren't commercial, because normally on commercial, because the loan amounts are higher, they cap the compensation usually to like 2% or something like that. Depends on the lender. But when it's residential, when it's either a house, a condo, a townhouse that the investor is going to rent out, they're not going to live in the property. That's the main thing. If you do a transaction where the borrower is going to actually live in the property, then you have to be licensed to do these kinds of loans. And then it's just a different process. And we do it with different lenders as well. So in this case, we're focusing on what's going to be most popular in the months to come in the economy all over the US and probably around the world as well. But right now, we're going to focus on the US, and we're going to be able to help as many borrowers as we can in the entire US. Doesn't matter what state. And the nice thing is that a lot of these lenders, they allow you to do this. So let's move on. Let's continue with this example. So this investor is purchasing a $900,000 multifamily home, and they're going to be coming in with 35% as their down payment. And you're going to charge 4% in compensation or commission. Back in 2008, when where real estate went down and there was a bunch of issues with legislation, a lot of people they decided to change the name of how loan officers are paid. They changed it they wanted to use the word compensation instead of commission, but it's still commission. It's based off the loan amount. That's what it really is. Now, let's calculate how much your compensation is going to be based off 4% in terms of commission. Now, this commission could be spread out by either having 2% being paid by the lender and 2% by the borrower, or maybe possibly having just the borrower pay you the entire 4%. Depends on what the lender allows as well, because sometimes they'll cap you at 2% or 3% as to what you can charge the borrower up front. So that's very important as well. Now, let's go ahead and continue. So to calculate the compensation, first of all, our compensation is always based off the loan amount, not the purchase price. So we're going to take 900,000, which is the purchase price, and we're going to multiply it by 65% because they're coming in with 35%. So the difference of 100%, we subtract 100% from 35%, we get 65% as the LTV, or the loan to value, which is what the borrower is financing, which in this case would be 585,000. And those 585,000 is what we're going to be paid off. Okay. Just so you're clear on that. So we're going to multiply 4% times those 585%. And the total commission would be 23,400. And then you're going to multiply that by the broker split, which is what we have here at Finity Mortgage, which is 50%. So that 50% is going to be 11,700. So that's what your profit is going to be, your compensation is going to be in this transaction. Now, let's move on to another example, because I want to finish a few more examples so that everybody's clear as to how you calculate interest-only payments, how to calculate prepayment penalties, how how much would be your compensation. These are important things that you're gonna be curious about on each and every transaction, which when it comes to your compensation, obviously you're not going to talk about that with your borrower, but when it comes to their payments and what their prepayment penalties are going to be, that they will always ask you, and you need to be 100% transparent with that. When it comes to interest rates, a very, very, very important topic that a lot of investors want to know is what their interest rate is going to be. And that interest rate can change in any moment. For example, if the investor decides now that they want to have escrows or they don't want to have escrows, interest rate changes. If they want to buy down the interest rate changes. If your compensation isn't factored in there, then that can change the interest rate. So what the key is, instead of giving them an exact interest rate, for example, a 7.865% interest rate, instead of doing that, you're going to give them a range. You can tell them the interest rate is going to be between 7.5 to 8.5. And if there are any changes, it could be higher. And then that way, it's harder to miss on the interest rate because you gave them a range. That's the right way to do it. That's the way I do it. And a lot of times, then you don't come up as somebody who tells them one thing and then gives them another interest rate. So you look terrible there. So it's much better to give them a range and always stretch the range on the higher side. Nobody's going to get mad if you give them a 7% interest rate after you told them they were going to be between 7.5 and 8.5 and you give them a 7%. Nobody will ever get mad. So you shouldn't worry about that. What you want to focus on is you want to go ahead and have a higher interest rate, and then that way everybody's comfortable with the interest rate range. So let's move on to example number 5. So for example number 5, if you close a $700,000 loan and you're making a 3% commission, what would be your final commission after the 50% split with your broker? So in this case, again, we're going to multiply the loan amount, not the purchase price, which in this case is $700,000 times 3%. That gives us $21,000. And then we're going to divide that in half, which would be $10,500. And that would be your final commission or compensation minus taxes. Now, years before, around 2008, before 2008, 2009, you were able to get paid as a 1099 employee, and you would be able to pay your own taxes off whatever you received. But legislation also changed that. Now everybody has to get paid as a W-2, which isn't good for you guys and it isn't good for me, because then they take away another, I think, depends on the state in which you're in, but normally it deducts another 11%, I think, or more or less from the loan officer, and it takes 19% from the broker, so from the company. So it's not good for anyone, but it's part of the process. So we just work with what we have. It's still very profitable and it's a great compensation, a great commission. So we can't complain anyway either. All right, let's move on to example number 6.
Yeah. How much money do they need?
Yeah. And then if you have 2 or 3 loans, and you're making $10,000, that's going to be, when the economy is going down, that's going to be a heck of an income compared to what everybody else is going to be making and struggling, because a lot of people are going to be in positions where companies are going to be laying off people. Companies are going to be lowering salaries. And when that happens, people are going to be looking for new jobs. They're going to be looking for solutions. But if you take a progressive approach like we're doing right now, we're getting ahead of the curve. We already know what's coming. Real estate has been doing this for such a long time. It simply doesn't last forever. That's the way it is. And when people's incomes simply aren't enough to be able to cover these higher purchase prices, when properties are already, reaching 700, $1 million, and people just simply can't afford to purchase those homes, they're going to sit on the market until finally people start lowering prices. And then that's when prices start going down and investors come in to purchase those homes. And that's where we want to be, giving out cards, letting everybody know what we're doing. So everybody that wants an investor loan, we're there for them. And believe it or not, a lot of people that are going to be investors are going to be family members, friends, co-workers, your neighbors. There's going to be a lot of people that you wouldn't expect to be an investor, but if they're a person that wants to purchase an investment property and they want to rent it out, now they are considered an investor. So it's very simple. So most people, everybody qualifies. All you need to have is the cash to purchase the home. All right, let's move on to example number 6. So we have an investor that's refinancing a home worth $2 million and they have a loan amount of $700,000, but they want to cash out $300,000. So how do we calculate this? And we also have to include the $33,000 in closing costs. Now, to be able to calculate their final loan amount, we know that right now they have a loan amount of $700,000 and they're going to refinance that. Plus they're going to take another $300,000. So we have to add both of them together to see what the total loan amount plus the closing costs. So if we take 700,000 plus 300,000, we have 1 million. And then we add the 33,000, which are the closing costs. So the total loan amount is going to be 1,033,000. And since the home is worth $2 million, if we divide that 1,033,000 by 2 million, we're going to have a 51.65% LTV or loan to value. And in the majority of our transactions, when they purchase a home, 80% is the maximum loan to value and 75% is the maximum loan to value when they want to take cash out of the home. So at 51.65%, we're perfectly fine. The borrower is going to qualify. And these are wonderful transactions because the borrower doesn't have to have the money in their bank account. They're using their home equity to qualify. So the only thing that needs to qualify now is the rental income. And the best thing of all is that there's 2 types of loans. In investor loans, there's either going to be DSCR loans, which basically calculate how much the total payment is going to be with how much the total rental income is going to be. And then we divide those and it needs to be 1 or under. So if the borrower receives $2,000 in rental income and they have $2,000 in payment and you divide 2,000 by 2,000, we get 1. So the borrower qualifies. But if for any reason the rental income is too low and their payment is going to be higher, they can still get the loan. They can get something that's called a no DSCR loan, which is a debt service ratio loan. When we don't calculate the debt service ratio, the borrower basically just has to have a good enough credit score, which is usually above 600. If they have a higher credit score, they get better interest rates. But in this case, as an investor, they qualify regardless. So this is one of the best loans to do and the easiest. Imagine you don't have to calculate their income because it's a no DSR loan, DSCR loan. When they don't have to calculate that debt service ratio, the interest rate is going to be higher. So it's going to be, let's say if they had an 8% interest rate, now they're going to have a 9% interest rate. But the lender doesn't ask any questions in terms of the rental income. So it's a win-win situation. For us, it's an easy loan. And for the investor, they qualify. They don't have to worry about anything. They just have to accept, number 1, the interest rate, and number 2, the prepayment penalty. And then we're going to ask them, if they want to have escrows or not. Most investor lenders require that the borrower has escrows. And if they don't want to have it, sometimes there's just an increase on the interest rate. So as you can see, this is one of the easiest loans you can do when you don't even have to calculate the debt service ratio. And when you're going from either an 8 to a 9% interest rate, and the difference is maybe $200, but they're not going to be asked any questions, borrower, the investor just has to say thank you, take the loan, and reinvest their funds if that was their plan. All right, let's move on to example number 7. So we're going to go ahead and calculate exactly what we talked about right now. We're going to calculate the debt service ratio, also known as the debt service ratio, the DSCR. Now, let's say the monthly mortgage payment is $4,565. Now, when I talk about the mortgage payment to calculate the DSCR, you have to include, if they have a homeowners association, taxes, and insurance, plus the interest only payment. So we add all those things together, and that is the mortgage payment. That's what we use to calculate the debt service ratio. And then we're going to divide that by the rental income. Now, a lot of times what a lot of people don't know is that when an investor hasn't been receiving that income or doesn't have it on their tax return yet, because they haven't been receiving it for a year, they're just purchasing the property, the lender won't let you use the entire 5%, the entire $5,000. They'll use maybe 75% of that or 90% of that. So there are cases or often where the debt service ratio won't work out. And when it doesn't work out, no big deal. We simply do a no DSCR loan. They get a higher interest rate and we don't even use that rental income. But for example purposes, we're going to do the calculation so everybody sees how it works. So in this case, we're going to take those $4,565. We divide them by 5,000 and we get 0.913. And if the lender requires that the DSCR be no more than 1, which in this case, it's under 1 because it's 0.913. So this loan would qualify. So the borrower would be able to choose to have the debt service ratio loan. So those are the two loans you're going to choose, debt service ratio or no debt service ratio, basically. There's other types of loans. There's bank statement loans. There's other types of loans. But in this case, when it comes to rental properties, it's plain and simple, which is awesome because it makes our life very, very easy. All right, let's move on to the next example. Example number 8. So now we're going to calculate the debt service ratio for a borrower when it's a no DSCR loan. And we have, in this case, a mortgage payment of $7,500 and a total rental income of $3,800. Now, this is a trick question. If this was a test question, most people would get tricked and they would do the calculation and they'd see that the loan didn't qualify under a DSCR program. And what they have to pay special attention to is right at the beginning, we said it's a no DSCR loan. So in this case, we don't even have to calculate that ratio, which is great. So you always have to take into account if there's any chance that the loan won't qualify as a DSCR loan, don't risk it, go straight to a no DSCR loan, because then that way the borrower, you simply tell them what the interest rate is going to be. If they want the loan and they need the money, they'll take it. If not, they can go and have their credit pulled by another lender and see if they qualify, which is not always as easy or fun for most people. So that's my suggestion. Okay. Now, I wanted to see, I'm going to go ahead and go back to asking everybody if anybody has any questions about the examples that we went over right now. Last webinar, we didn't have time for questions, but I want to go over some questions today. And then I want to go over a quick overview of the website so that I can show you guys. Actually, let me do this real quick. Let me go to our website. So all the way on the top, we go to finibmortgage.com/investor-loans.php, which I've sent to everybody. Everybody that signed up with us already downloaded this package over here where it says loan LO sign up process package and sent that over. So they're already ready to go. But if you scroll slowly down, you're going to see the 4 steps to get started. Pretty simple. You're going to submit a loan scenario, which is right down here. So you're going to enter the borrower's information, the loan amount, their name. And this is just to have general information to see if the borrower is a qualifying borrower. Here, you're going to enter your name. Make sure you always put your name there because I need to know who is that referred the loan and your email address and your phone number so I can call you or email you and ask questions about the loan. And then if there's any important information you want to include, this is information you're actually sending to me so I know what you're talking about. So if you tell me, oh, the borrower wants a no DSCR loan, then that way I would know. The borrower doesn't want to have any prepayment penalties, or the borrower wants to have a loan no higher than 10%. And then I can tell you if it's realistic or not. And then we go all the way back to the top. Then you take this link and you're going to copy this link. And this is the link you're going to send the borrower. This pre-qualification link goes to the borrower. And what they do is they enter all their general information so you don't have to do the work. And it pulls their credit. So we're able to see their credit, which is, there's not much to qualify investors. We need their purchase contract if they're buying a home. We need their credit, and then we need to make sure they have enough money to be able to come in with the down payment and closing costs and the reserves. If they're refinancing, it's even simpler. We need to make sure we have their credit scores, and then we need to have the basic documentation from their home. So we need to have their mortgage statement, their taxes, and their insurance. You will always ask for their driver's license, but in terms of the pre-qualification link, very, very important. That's what you send them. Once we have that information, I'll go ahead and provide you with an interest rate, and we'll see if the borrower accepts those terms, prepayment penalty, interest rate, whatever it is going to be, whatever the range is going to be. And if they're fine with that, then we move on and we send the borrower the documents to complete. The 1003 is the only thing you have to complete, plus sending them those documents to sign. Each lender has their own specific forms, but most of the time it's a submission form and an e-sign authorization form. Those are the two that all lenders require. So there's a lot less documentation, which is nice. And that way the borrower can receive emails and e-sign those documents. And second, the submission form is basically a form that tells you all the requirements the borrower is going to accept to. And then we go ahead and provide any documentation, including requesting the appraisal or any other documentation the lender needs. And then we close on the loan and everybody gets paid. So that's the process. But the two main steps you want to do is the loan scenario, to kind of get an idea of what this borrower's, how to steer this borrower. Where are we going to go with this borrower? DSCR program, no DSCR. Does the credit score qualify? Do they need more down payment? Will they need to get a family member to help them with the funds to close? They are perfectly allowed to receive gift funds, just so you know. Family, parents, they're allowed to receive gift funds, so they can qualify easier that way. All right, so let's go below the loan scenario. I went ahead and included already the loan application, which is the one thing you need to have the borrower complete. I have a course on how to complete the 1003. So if you want to take that course, it's very helpful. It goes over each one of the lines. The one thing you have to remember, please pay attention real quick. Do not put the borrower's income. You put their employment, they work as a lifeguard, as a police officer, as a real estate agent. The lender does not care. You do not enter their income. That's the only thing you don't enter, because this is an investor loan. We're using the rental income, not the borrower's income. And if you do, they're going to kick back the application and ask you to please erase or remove the borrower's income. And then second, there's the borrower signature authorization. If you use the link on the top, the borrower is going to automatically authorize you to go ahead and pull their credit, which we always need. I have here, if you want to click over here, sample business cards. You can use these business cards to copy the exact same format. You include your email, your phone number, and then the company name, so that way everything is in order. If you need the company logo, it's right here, which is in a JPEG file. Now, instead of going off to some of the other processes, which you can go ahead and read on your own, with what you'll need when it's a refi and when it's a purchase, I want to go over any questions that you guys have. So feel free to ask me anything you want.